Hey guys, so reaching the goal of one day living off your passive income can sometimes feel really overwhelming, maybe even impossible, especially if you're somebody like me and you invest with a low budget. But knowing the right metrics makes all the difference. So in this video, I'm gonna give you guys 4 metrics that you really need to pay attention to, especially as a low budget investor, and how that resulted in me selling one of my oldest positions and buying a few more in replacement. One of the first dividend stocks I actually invested into was AT&T, and almost 6 years ago, I didn't know much about researching dividend stocks, but I knew 3 things about this company. 1, I knew what the company did. 2, I knew subjectively it was a fairly cheap stock at the time, and 3, I knew that dividend yield was really high. What I didn't know is that I would be selling one of my oldest positions over 5 years later after really understanding what I should be looking at when it comes to making a small amount of money grow over the long term. So with that being said, here are the 4 metrics that led me to selling companies like AT&T. This isn't part of the 4 metrics, but when it comes to living off dividends, understanding how much you think you'll need in the future and understanding how inflation works pretty much puts all this together. Like, you may expect to live a lifestyle that requires, let's say, $5,000 every single month. Well, $5,000 right now will probably be a lot less than what $5,000 is in the next 20 to 30 years. For example, using this inflation calculator, $60,000 back in 2020 would have ended up being over $72,700 by 2024 with the 21.2% inflation that was taking place, which obviously is pretty crazy. Normally at a healthy rate, inflation or the general price of goods and services increases about 2% every single year. So when it comes to dividends, you want to make sure that whatever stock or ETF you invest into not only has a history of consistently paying those dividends, but consistently increasing those dividends, ideally at a higher percentage rate than the rate of inflation. So when you first invest into a dividend stock, you get the dividend yield that it initially has. And over time, the stock price will inevitably change and the dividend yield might change as well. The yield on cost, on the other hand, is like your personal dividend yield. It's based on the current dividend payout that the company has versus how much you initially bought the stock price for, whether you bought it all at once or you dollar cost average into it. For example, let's say that you buy company A for $10 a share, and at that point in time it pays a 1% annual dividend yield, or about 10 cents per share per year. But then 5 years later, that payout ends up going up to 25 cents. That would actually make your yield of cost 2.5% rather than 1%. And that's just the current annual payout divided by the share price you bought it at, or your average share price if you dollar cost average. When you have a stock that the yield of cost increases as you go further back, that's always a great sign. It shows that dividend yield is typically growing over the period of time. With AT&T, however, the yield of cost actually decreased the further back in time, meaning the company hasn't grown its dividend yield over the past 5 years, which isn't a good look if you've held for the past 5 years like I did. Whenever you look up a position, stock, or ETF on Robinhood or Webull or anything like that, you can immediately see the share price trend over a given period of time. What you're seeing at that point is the price return. What it doesn't show you is what it would look like if you reinvested the dividends back into that position if it offers dividends. That result is your total return. So if you're investing into a position that has a history of increasing its share price and has a history of consistently paying and increasing their dividend, then you would expect that position to have a pretty high price return, but an even higher total return, assuming you're reinvesting those dividends. With AT&T, its total return was pretty high. It was about 42%. However, you can see if you had pocketed the dividend, which you might have considered because the yield was pretty high, you would have lost 42% of your investment over that same period of time. When applied to many things, the compound annual growth rate basically takes 2 periods of times, like years, and it determines the percentage increase that it would take between each year to get from year A to year B. And when it comes to dividend stocks, you're looking for something that consistently increases its dividend yield, ideally by more than the rate of inflation. So with that, you want the 3, 5, and 10-year dividend compound annual growth rate, or dividend CAGR, to be positive. Now, when you look at AT&T, its 3, 5, and 10-year dividend CAGR are all negative, meaning for the past 10 years, the dividend yield is trending enough to where you're losing a little over 2% per year, even if there were increases with that 10 years. That just means that the decreases within that 10 years were drastic enough. So next you have free cash flow. Free cash flow is the money that's left after a company pays off everything it needs to pay off and is also done investing on its future expenditures. And what's important about the free cash flow is that's typically where money's pulled from to pay shareholders their dividends. So with that, a trend of the free cash flow of a position consistently increasing or at least staying stagnant is really important as a dividend investor. With AT&T, you can actually see that they're starting to look on the up and up between 2023 and 2024 with that increase. But as someone that invested into them for years, I'm looking at the years prior, which show a decrease. That can also help explain why the dividend CAGR had been decreasing over the same period of time and then some. It is very possible that with the trend that AT&T is going on right now, had I kept dollar cost averaging and just continued to hold on to it, I might have made my profits back over the long term. But at that point in time, I really wanted to just take that money and I felt like I could put it into better positions that could make me more money with growth and, in this case, passive income for the long term, better than AT&T would. And one of those positions I decided to invest into is Williams-Sonoma. So out the gate, Williams-Sonoma has a consistently increasing share price growth, increasing by almost 100% this past year, by over 400% for the past 5 and 10 years. So more comfort in their company and also potential for dividend growth. Now, percentage-wise, they have a pretty low dividend yield, but they do have double-digit dividend CAGR for the past 3, 5, and 10 years, and they're all well over the rate of inflation. The yield of cost is also great since it's higher the further you go back, also proving how they've been able to increase their dividends over time. That growth and that share price growth really show the impact of their total return and their price return, which are both really high. But reinvesting dividends over the past 5 years would have made you an extra 60% in profits. The only flaw I saw is with their free cash flow, but again, even with that, they still have a positive history of dividend growth. Now with this position, I started investing into them just last August, so I'm still fairly new to it, but even with it, I've still made so far over 50% in growth. So hopefully that continues. The other company is Broadcom, and just like Williams-Sonoma, they have a great track record of share price growth, including 115% in the past year, 668% in the past 5 years, and an insane 2,119% over the past 10 years. The dividend CAGR is also a good look at 13 and 14% in the past 3 to 5 years and 33% in the past 10 years, which honestly makes me wish I knew about this company 10 years ago, and honestly, I wish I was investing in the stock market 10 years ago. Also, despite the fact that they do have a dividend yield that's less than 1%, which doesn't look great to begin with, they do have a 1, 3, and 5 year yield of cost of 1.79, 3.85, and about 7%. On top of that, they have a consistently increasing free cash flow over the past 5 years, which is super promising. With all that, the price and total return are both really high for the past 5 years, but if you reinvested those dividends, you would have made an extra almost 100% more in unrealized profits. Now, Broadcom is a position that I legit started investing into like last week, I think January 13th, but so far I've made over 5%, so hopefully based on its history, I can see more in the long term. Of course, I'm sure there's more metrics out there, but I'm pretty confident that these 4 metrics have helped me take my $30 a week and put them into the best position to grow over the long period of time in profits and of course passive income to maybe one day I can live off of it in the future. Now, another position that I like to invest into for the same exact reason is SCHD. And I actually made a video about it last week where I talk about why SCHD is a high contender for someone with a low budget that wants to invest into a position with high growth and high dividend payout history. So I would definitely check that out if you have time. I appreciate you guys watching this video. And until next time, as always, take care.